Let me be very clear at the start of this video, because this is not one of those fun conversations about price targets, moon math, or when XRP hits some magical number. This is one of those uncomfortable conversations that most people are actively avoiding. Digital ID is coming, and it's coming a lot faster than most XRP holders realize. And here's the part nobody wants to say out loud. If XRP actually succeeds, if it actually becomes infrastructure, retail holders who are unprepared could be the ones who suffer the most. Not because XRP fails, but because it works. And that's what we need to talk about. Right now, the XRP conversation is completely distorted. It's all about ETFs, institutional adoption, banks, liquidity, and price appreciation. And yes, those things matter, but they're not the most important part. The most important part is what happens to you once XRP is no longer treated as a speculative crypto asset, but as a regulated financial instrument inside a fully digitized system. Because once that line is crossed, the rules change permanently. Most people still think in old crypto terms: cold wallets, self-custody, no KYC equals privacy. That world is disappearing. And it's not disappearing because of some conspiracy. It's disappearing because crypto is being absorbed into the global financial system, and XRP is right at the center of that absorption. Here's the illusion most XRP holders are operating under. If I self-custody, I'm safe. If I don't keep funds on exchanges, I'm invisible. If my wallet has no name attached, nobody can touch me. That thinking is outdated. Blockchain was never designed for anonymity. It was designed for traceability. Every transaction, every movement, every pattern. The only reason anonymity existed in crypto was because regulation hadn't caught up yet. Now it is. And governments don't need your private keys to control you. They don't need to seize your XRP. They don't need to hack your wallet. They don't need access to your ledger. All they need is identity mapping and legal obligation. And that's exactly what digital ID systems are built to do. Digital ID isn't just about logging into websites or accessing government services. It's about linking identity to economic activity. Wallets, exchanges, on-ramps, off-ramps, payment rails, tax reporting, cross-border transfers. Once digital ID frameworks are in place, the question is no longer, do you own this wallet? The question becomes, can you legally explain everything that ever moved through it? That's a very different problem. Under emerging frameworks like DAC 8 in Europe, OECD reporting standards, and expanding crypto asset reporting rules, crypto activity is becoming automatically reportable across jurisdictions. Even if you don't live in Europe, even if you never touched a European exchange, if the service you use has exposure, your data flows into the system. This is not theory. This is implementation. And once XRP becomes a core liquidity rail, it will be one of the most monitored ledgers in the world. Not because governments hate XRP. This is the most important sentence in this entire video. Self-custody protects the asset. It does not protect the owner. Governments don't regulate wallets. They regulate people. They regulate identity. They regulate residency. They regulate tax obligations. They regulate legal ownership. If your XRP sits in a wallet directly associated with you through KYC history, IP patterns, exchange withdrawals, or reporting frameworks, then you are the point of control. And once reporting becomes mandatory, the burden of proof is on you. You must explain where the XRP came from, when it was acquired, how it moved, why it moved, how it's classified, how it's taxed. If you can't, that's when problems start. Not because you did something illegal, but because you were unprepared. One of the most dangerous misconceptions in crypto is this: I'll deal with it later. Later doesn't work in regulated systems. Once reporting rules are active, governments don't just look forward, they look backward. Wallets don't forget, blockchains don't forget, records don't disappear. Movements you made years ago can suddenly become relevant under new classifications. Transfers between your own wallets can be reinterpreted. Off-ramps can trigger audits. Large withdrawals can freeze accounts pending documentation. This is already happening, and it accelerates the moment XRP becomes widely used by institutions. High net worth individuals don't hold valuable assets directly under their personal identity. Not real estate, not businesses, not equity, and certainly not digital assets that move across borders. They use structures, entities, trusts, foundations, companies, not to hide, but to classify assets correctly. A legal structure changes everything: tax treatment, reporting obligations, liability, inheritance, continuity. When an entity owns the asset, the person is no longer the sole point of exposure. That distinction becomes critical once digital ID systems fully integrate with financial infrastructure. And this is why many serious crypto holders are already restructuring quietly. Not because they're scared, but because they understand where the world is going. Real adoption is not bullish candles. It's not viral tweets. It's not hype cycles. Real adoption is regulation, reporting, oversight, integration, compliance. That's the price of becoming infrastructure. And XRP is walking straight into that reality. If XRP succeeds, it doesn't become freer. It becomes more visible. And visibility without preparation is exposure. Here's the part most XRP holders haven't fully processed yet. Digital ID doesn't just connect you to your wallet. It changes who controls the story around your XRP activity. Right now, if someone asks questions about your crypto, it's usually reactive. You respond when you choose to engage. In the digital ID world, that flips. Authorities, banks, and compliance systems don't wait for explanations. They generate them automatically. Once digital identity layers are connected to financial rails, your XRP wallet activity becomes part of a broader behavioral profile. Not just balances, patterns, frequency, timing, counterparties, movement logic. At that point, it doesn't matter whether you intended something as a transfer, a rebalance, a gift, or self-custody housekeeping. The system assigns meaning first. You defend later. That's the subtle danger. Digital ID systems aren't designed to ask why. They're designed to decide what something is and classify it instantly. And when XRP becomes settlement infrastructure instead of a speculative token, the tolerance for ambiguity drops to zero. This is why preparation matters now, not after mass adoption. Once the rails are live, interpretation becomes automated, and automated systems don't care about your intent. They care about classification. Let me say this carefully, because this is where people get emotional. The future system isn't about banning self-custody. It's about permissioned relevance. You'll still be allowed to hold XRP. You'll still be allowed to self-custody. But what changes is what you're allowed to do with it, and how smoothly. Permission will increasingly determine how easily you can off-ramp, whether a bank accepts your transaction, whether a transfer triggers enhanced review, whether your funds are temporarily frozen for clarification. Not because you did anything wrong, but because the system requires certainty. And here's the uncomfortable truth. In regulated financial systems, certainty comes from structure, not ownership. A personal wallet proves control. A legal structure proves legitimacy. That's why institutions don't operate in their own names. That's why large capital never moves without wrappers. That's why compliance exists, not to punish, but to standardize. Retail XRP holders who ignore this shift aren't being rebellious. They're being unprepared. And the irony is, the more successful XRP becomes, the more visible this problem gets. Utility doesn't reduce oversight. Utility invites it. This video isn't meant to scare you, and it's not meant to tell you to sell XRP. It's meant to tell you the truth. The biggest risk for XRP holders isn't price volatility. It's being unprepared for success. Digital ID is coming. Regulatory integration is accelerating. XRP is moving toward the center of the system. If you still think like it's 2017, you're late. If you think a cold wallet solves everything, you're exposed. If you think anonymity is guaranteed, you're mistaken. The next phase of crypto rewards people who understand structure, not hype. Protect the asset, but more importantly, protect yourself. Because when XRP becomes real infrastructure, the rules stop being optional. And once that happens, the holders who planned ahead will move freely, while the rest struggle just to use what they own.